So lease again, it's a difficult standard. So I touch upon Appendix C of Ind AS 17. That is the most crucial change in Ind AS 17 and AS 19. Then assets arising out of employee benefits, that is IS 19 revised, and we have Ind AS 19. It's basically IS 19 revised in 2013. That is 2013 IS 19 is revised. Earlier IS 39 is equivalent to our IS 15 because our institute adopted it when IS 19, previous IS 19 was there, but IS 19 revised in 2013, so that's we are reading in Ind AS. Goodwill IFRS 3 business combination, though the most difficult standards after IFRS Ind AS 109. Then non-current intangible assets held for sale, that is equivalent to, if some bit extent equivalent to our 24 AS 24 discontinuing operation, I think this particular asset, but here it's called as asset held for sale basically. So these are the scope exceptions. It's the similar thing, this particular item, some intangible assets are contained in a physical substance, that is computer software or compact disk, legal documentation in the case of license. Question whether an asset that incorporates both intangible and tangible elements should be accounted for under Ind AS 16, property plant or equipment, or AS 38, that is Ind AS 38. It's a very simple question.
It has to be either fish or food. New asset can be both tangible and intangible. That choice has to be made.
What about it? Software coming along with computer?
There is no component account.
If it is incorporated in without which the machine will not run, it will be under PP. The basic software which is written on the hardware should be in PP, and those are say operating, that is the software which is run on those hardware, those are only should be as intangible.
So to answer this question, there is no difference, but yes, that is the right answer.
But I saw one balance sheet where there was a toll bridge which was previously recognized as financial asset, then it became intangible asset. With the change of auditor, it became intangible asset. Same asset.
But under Ind AS also, if you look at that particular SIC, it is called Service Concession Arrangements, SCA. So those arrangements are basically intangible assets in our financial statements. Very rare case it will be as tangible assets, very rare case. So Ind AS also same. So answer is, should use your judgment to assess whether intangible element or tangible element more significant. This is the answer you have given, sir. This is the same answer.
So point is, in case of tangible we can get bank loan. In case of intangible we can't.
That depends on bank, no? Whether he will give a loan or not. As the definition is, intangible assets are an identifiable non-monetary asset without physical substance. An asset is the resource controlled by the entity from which I will get future economic benefits. Simple.
Sir, excuse me. The previous slide.
Yes.
The significance is relevant or integral aspect is relevant?
Sorry?
Which is relevant? Integral part of the that item or significance of the item? You mentioned that which is more significant, that will be.
Yes, more significant.
In the case of you just mentioned about the computer, the software is not very significant, but it is integral part.
So it will be hardware. Computer, I will capitalize computer.
What we have to look at, the significance or the integral aspect of the thing?
Both the items, you have to apply your judgment.
Yeah.
So that is the one tricky in the question. So judgment.
You mentioned about the integral.
So if you look at the definition, identifiability, control and future economic benefit, these are three major factors when you are accounting for intangible assets. It is separately identifiable, Second is that you control that particular asset, and by your control you will get future economic benefits out of that particular asset. Then you will account for that particular asset as an intangible asset under Ind AS 38, and there is no difference with AS 26 here also.
Can you please elaborate control? Control.
In what way you are asking the
I
control?
mean, control is what? As in substance, what will the touchstone of control?
Okay. So control in our Indian gap, earlier gap, control definitions are a huge difference in Ind AS. If you come to Ind AS, control's definition totally gone for a change. Okay. But for that particular control and this control are totally different. That control we use when we assess particular entity for consolidation, whether it is a subsidiary, joint venture or associate, or it is a joint operation. So in that particular control, if you want to evaluate whether I will control that particular entity or not, so that control and this control is bit different. Here you control the economic benefit, means the asset is in your name and whatever return you will get from that particular asset is with you. Yes, the risk associated with that asset is also shared. So this control bit different from that control which we discussed last time in the particular theme. So if I will take Ind AS 110 or 111 or 112 or separate financial statement 27, then definitely we will use that control, and it's a very lengthy definition and it's a very tricky one. So to understand control under Ind AS, to conclude particular entity, touch upon just, there is a subsidiary. Earlier we account for that particular subsidiary, we holding 51%, we account for that particular under Indian GAAP as per AS 21 as subsidiary. But today when we are evaluating the control, we are not controlling that, we are jointly control that particular entity. So only holding equity shares will not give me the control over that entity. What will go for a change? Earlier we have consolidated that particular entity, but today I will do equity accounting as associate accounting we do. Proportionate consolidation is gone away. Only in a limited circumstances when we conclude particular joint operation, particular joint venture as a joint operation, joint arrangement as a joint operation, that point of time the proportionate consolidation is there. Otherwise that proportionate consolidation which we read through in our previous standards, that is not there in Ind AS. And even though you hold more than 51% shares, if you are not able to evaluate the control over that particular entity, you are not going to consolidate it. What you will do? You will do the equity accounting. In equity accounting is the associate accounting under our previous standards. That is 23 AS 23 standards. What we do? Our holding plus minus the PL movement, that is equity accounting. So we will have to do equity accounting for lots of subsidiaries where we have done earlier. Our net worth is such a big number, but today all the asset liability will reduce, all the fixed assets will reduce, everything will be reduced, our consolidated financial statement will shrink if we will not establish the control. And it's not limited only to the shareholding pattern, that's the most important thing. You have to evaluate other criteria. So that's a most significant change in the standards Ind AS and Indian GAAP. So this control is not that.
So if our copyrights are very weak and then software can be pirated or movie can be pirated or song can be pirated, then that means we have got no control over that. We can't pirates.
I have control over that, but they are using illegal methods.
But if
So
we
I
can't
cannot
enforce
restrict
that
that.
control, if we can't enforce that control has to be enforced. No?
Correct.
Can't enforce, then adverse person on our building, on anything.
He will not recognize an asset. Here the control definition is given. This is the question for all of you.
We cannot force them to leave from leaving. They cannot be or
You don't have
we can't be sure that we will continue to use their services.
All no? Anyone yes? Yes, sir. Let me find out a friend for you. If anyone will be yes, then I will take your answer. Because all are no. All are no? Yes or no? Yes.
Those who say yes, let them justify it.
Okay.
Yes, justify it. Yes, doctor. We don't want everyone.
No control, so
Sir, can we hear the logic of answering yes?
Because actually, based on actual model, how many persons has gone out and have come in, we can always value the skill.
Intangible assets having three particular things: identifiable, you control, and future economic benefit out of that. So I can identify particular these things. I can get the future economic benefit, but do I control them legally? I don't control them. Tomorrow if they all want to leave, I cannot stop them. So tomorrow if I today recognize these particular assets, tomorrow I will take full impairment. So I don't control them. They can leave any day. Legally I don't.
In the same context, when I do actual valuation of the gratuity,
Yes. Yes.
I always estimate how much is the future liability based on the accretion I had in the past. So I know I always be able to do, although I am not controlling it.
So there is no point of control. That little bit difference, sir. That is your policy, company's policy to pay gratuity. So today, when you are preparing your financial statements, you are assessing how much gratuity I will end up paying to all my employees. So what is the policy written? That I will pay gratuity to all the employees, those who are working more than 5 years with me, this much amount at the date of retirement. And what will be the method of calculation? The basic and DA they are drawing on the date of retirement into number of completed years of service. So today what you are doing, when you are calculating all the members, all the employees of yours, to today if you calculate the gratuity today, then you are discounting it. You are recognizing the present value today. If you are able to calculate it as today only, then there is a particular progressive computed method. If you remember, progressive unit link method that is suggested by AS 15. So Ind AS 19 also, the method is not different, the same method. So what that is talking about, you recognize liability today at present value. You are recognizing at present value. If all the employees leave today, how much you have to pay? That is the present value of that particular liability. But the way you are calculating it is that you are taking the attrition rate, mortality rate, then the return rate of return. Okay, so you are doing that. So by that you are not controlling all those employees.
I am not controlling, but all the same formula can be applied in the valuation of the skill.
No, you cannot value that. You don't control legally. You cannot enforce that.
That is imposed, but logically, if you see the common sense arithmetic, so it will.
If you want to really value that asset, yes, your method is very suggestive. But you cannot value that particular asset because you don't have legal right. That is the simple.
Secondly, sir, there will not be any shelf life of skills. Skills can become obsolete very quickly.
So in that case, in this event, is basically becomes a rule based
no
and not a conceptual.
No, it is already there in our Ind AS 16, AS 26. There is no difference in this particular line item. I will come to the differences where
In what we are told and what we are learning, that there is a difference between our original AS and what is in AS. One was in the rule based and other is on the
Ind AS is on principle based.
principle based. So
So Ind AS you can do the same for different accounting for the same thing. It's not rule based that you have to do it. If you conclude it, if your decisions or your judgments are correct, then you can do it.
But suppose if you have a bond, say for 3 years or 5 years with employees, then what? Can we amortize the cost over that period?
I will answer this question after intangible assets. So answer is, may expect the staff will continue to use their skills to serve the entity, however usually has insufficient control over the expected future economic benefits from it, hence cannot recognize as intangible assets unless it is protected by legal rights. Example, binding agreement stipulate the employee will service over a certain period. These kinds of agreements are illegal in India. So even though you can make these agreements, if somebody will go to court, then this will be throwaway. Because you cannot have employer-employee agreement. You cannot bind someone to work with you. Sorry?
We can do something else, sir. We can give them loose loans and say until they repay the loan, they cannot leave.
That will also not be binding.
Like banks do.
So on initial measurement, the cost needs to be measured reliably. So initial measurement is always measured at cost. Intangible asset always measured at cost. Subsequent measurement, there is an option. So this government grant is a new thing in Ind AS, basically Ind AS 38, which is not there in AS 26. This particular government grant. AS 20 is Ind AS 20 is relating to government grants, government assistance rather. Government assistance, when you are getting an intangible assets free, when you will get an intangible assets free, giving an example, radio station or particular legal right to import, these are intangible assets. These are intangible assets and you get it free. So the accounting will be in Indian GAAP, there is no accounting for this particular thing, and normally we end up not accounting all these things. But when you come to Ind AS, you have to account for the government grant also, and you have to account for the intangible assets. Again, intangible assets will be amortized over the period. Government grant will be taken to deferred income, which will be reversed to your P&L, over the period of the asset, amortizing into your P&L. So basically your P&L and your balance sheet will be nil. There is no impact, but you have to do the accounting in that manner. You got my point?
So can you please?
Does it cover incentives?
What kind of incentive you are talking about?
Like sales tax incentive or something?
Yes. Sales tax incentive will not qualify for intangible assets, but it's qualified for government assistance, income and grant. So you have to account for that government grant.
So till now we have been booking it as income. So from next year we will be booking it as intangibles.
No, I'm not said. What I said is that these particular government assistance, this sales tax incentive, export benefits, all these are government assistance to the companies. Those will be driven by the accounting principles of Ind AS 20. Ind AS 20, if you got any particular asset free from the government, intangible asset free from the government. Intangible assets, I took an example of airport flying off all these buses. This is a right. The Air Force Authority of India given me this right, that this particular company only fly bus inside the airport. So this is a right by which I will get future economic benefits from that particular assets. So it meets the definition of intangible assets. So I will recognize intangible assets. When I recognize intangible asset, I have to credit something. So then Ind AS 20 will come into picture, that it's a government assistance, it's a government grant. So what you have to credit? You have to credit deferred income. So this intangible asset having a useful life. Useful life may be finite or indefinite. Okay. So if the useful life is 10 years and this government deferred income will be reversed into your P&L over the 10 years. And the same logic will follow, the whatever depreciation come hit your P&L, this particular government deferred income will come and hit your P&L. This is the example. Any question?
Carbon credit.
Sorry?
Carbon credit is saleable current.
One.
Import entitlements against export.
Sorry?
Import entitlements against export.
Yes.
Then what is the intangible assets?
Again, intangible assets are no way linked to this thing. Only when you will get particular intangible assets free of cost from government, then government assistance comes. Your question, import duties, import benefits.
Import entitlements.
Okay.
Which are saleable in the market.
Okay.
I am exporting goods.
That's a government assistance, basically.
Yes.
When I am importing under EPCG schemes, everybody aware of Export Promotion Council. So EPCG scheme, I am imported particular asset with zero duty, with a commitment to export 6 times or 7 times whatever duty I have saved. So this meets the definition of government assistance. No way intangible asset is relating to it. Intangible asset come into picture only when you are getting a particular intangible asset free of cost. Then how you will account for it?
So my question is, government never gives anything for free. So either we have to suffer a disadvantage or we have to incur certain cost to earn that privilege. Can we adjust that cost against this income?
Example.
Suppose we set up a factory in a remote area and we get transport subsidy. It's a government grant, but we have to incur extra expenditure towards, or we have to incur extra cost or develop infrastructure there in order to exist. So can that cost be adjusted against this grant?
No, this grant,
Principle?
this grant, particular, if you are taking your example, if you are gone to a very difficult place and to encourage industry over that place, government has given you certain incentives. So yes, it meets the definition of government assistance. So now this government assistance will be accounted for in your books. If you are receiving cash for that, then cash you will debit and deferred income you will credit. If you are receiving any assets, intangible or tangible, you debit those, credit this deferred income. In future, when you have only received cash, then this deferred income is linked with certain parameters, obligations. So once you fulfill those obligations, this deferred income will recycle to P&L. It's a liability in your financial statements as on today on the receipt of the assistance. Then it will be recycled to your P&L over the period of the obligations you made.
But those obligations cannot be adjusted against it, the cost of those obligations.
You cannot adjust. Indian GAAP allows two things. Government assistance, if you are getting for a particular non-depreciable assets, you can adjust with the book also, asset value also. So you can account for net, but Ind AS does not allow that. You cannot account for net. Means if I am saving any duty in purchasing assets, then I will not net that particular assets value. What I will do is that I will recognize deferred income, and the second thing, I will recognize that particular asset at gross value. So Ind AS 20 and our grant standard, which is 12, I think, is a bit difference. Both the approach are acceptable in AS, but only one approach acceptable under Ind AS. That is, you cannot adjust that thing. Okay?
It's mentioned in Ind AS 1 also that netting off is not allowed unless it's.
So,
The netting off is not allowed. It is mentioned in Ind AS 1 also.
yes. That netting off is when you have a right to set net. Okay, so that netting off is little bit different from this particular thing. Here, what Ind AS 20 talks about, when you receive any government assistance for a capital assets. So government assistance accounting cannot be done net. Means you cannot recognize that particular asset net of that. Gross of asset 100 rupees you have to recognize. You have to recognize a government grant as a deferred income, which deferred income will recycle to P&L over the useful life of that particular asset. Okay. So if you get any government grant, means intangible asset which is free of cost from government, then you have to account for the government grant also and the cost of the assets also. Intangible assets sometimes we got in business combinations. Business combinations, bit means very different from what accounting we did in our Indian GAAP. So in business combination there is an option to account for the assets we take at fair value on the date of business combination. So it's first need to meet the definition of business. Business means input, output. Okay, so it meets the definition of business. It's a business combination. If you are getting any intangible assets on the date of business combination, it will be measured at fair value or cost. So first, measurement principles for intangible assets is at cost, always at cost. First initial measurement. But when you are going to business combination, the initial measurement is at fair value or cost. So both the options are there. If you are okay, so business combination, it's the date of fair value, so you have to value that particular intangible assets at fair value. Then you follow the cost model or revalued model. We will come subsequent measurement. Then it is an option. You will follow cost model or revalued model. Internally generated goodwill, it cannot be recognized under Ind AS also. Earlier in Indian GAAP also we don't recognize goodwill, no? Internally generated goodwill, do we recognize under Indian GAAP? So it's the same. You cannot recognize internally generated goodwill in Ind AS too.
So Kingfisher did that and they got loan also. It was an IFRS compliant company.
Sorry?
Kingfisher Airlines, they recognized the plant in their books. They got bank loan and it was an IFRS compliant company.
I need to go through the Kingfisher balance sheet. I will look into it. Research development R&D is the same thing. Research phase you will not able to recognize anything. Development phase yes, you can recognize that particular assets if all the parameters made for development phase, so you can recognize that. No difference from what we read in our previous standards. This is the one thing which is a bit different from our previous standards. That is intangible assets, indefinite useful life and finite useful life. So no amortization impairment test and amortization impairment test. So in case of indefinite useful life, which is the goodwill which we recognize when we did business combination, so that particular goodwill in our Indian GAAP we used to test when there is an impairment indicators. But when you come to Ind AS era, you have to test goodwill every year, whether there is any indicator or not. You have to test for the impairment. So impairment needs to be carried out every year, irrespective of any indicators are there or not.
This is for goodwill or for all intangible assets?
Any intangible assets having infinite life, you have to
Every year impairment test.
impairment test.
So have they provided any guidelines how to do this fair value do this thing every year?
Impairment test.
Yes.
Impairment test standard, if you look at Ind AS 36 and our previous standard 28, if you compare those standards, you will not find major differences. No major differences. Except you can test for impairment when you are classifying your subsidiary associate joint venture under Ind AS 27 at cost. Earlier, our investment in subsidiaries associate joint venture, those impairment standards are as per 13, age 13. That permanent diminution is there, then we took the permanent diminution in our books. But coming to Ind AS, any equity investment is a financial asset. Financial asset impairment is driven by Ind AS 109, but there is a scope exception that if you invest in your subsidiary associate joint venture and you are carrying those subsidiary joint venture associate in your books at cost, you have not fair valued those at cost, then the impairment model will follow 36. that is for non-current, that is non-current assets. That is 36 impairment standard that is followed. Instead of IFRS 9, that is Ind AS 109, you will follow 36. That is the only difference.
Otherwise, how will we, do this testing?
Minimal testings are there. If you go to impairment standards, so again recoverable value, carrying value more than with recoverable value, then impairment is there. So recoverable value is value in use or net realizable value, whatever is there, which is higher. Value in use can be calculated, various methods are there, like discounted cash flow methods are there, okay, earning multiple methods are there, all those methods are there. And net realizable value, again you will take the standards Ind AS 113, that is fair value measurement, fair value how you calculate. So fair value minus cost of FBLCD, that is fair value less cost of disposal. Fair value less cost of disposal and value in use, whichever is higher is the recoverable value. So the similar standard, only FBLCD is another thing which is different from our previous standard.
What about brand valuation?
Yes.
What would be the treatment like?
Brand is having no life, no? That is indefinite useful life. So if you are doing any brand valuation, you cannot recognize first of all. It is your own generated things.
So
If you are
I can buy a
correct, it is acquired. And this particular brand is indefinite useful life because you don't know in how many years. If it is a restrictive useful life, then amortization will be done. Means in 15 years your brand, this trademark will expire. So 15 years you can amortize it. But it is an indefinite life, then you have to test for impairment. How to test for impairment? This particular brand, when I am acquiring, paying something, I have an estimate that this brand will going to give me this much of business or generate this much of revenue for me in future. So in that way, you have to do the impairment calculations. Subsequent measurement, which I talk about, that is cost model and revalued model. So bit stop here. When we are date of transition, we have intangible asset in our financial statements and we follow cost model, not revalued model. I am taking an example of cost model. So when we are going to Ind AS, how we will treat these intangible assets? So Ind AS 101, which is a standard applicable for date of transition. So that standards given of option of 3 options given. Either you choose revaluation model or cost model, you do revalue of all these assets, you do that, and you will have to do in future all intangible asset revalued model. So you gone away with cost model. Second option is deemed cost. 101 gives option to deemed cost. What is this deemed cost is? Deemed cost is cost or fair value. But in future you will apply cost model. So this cost model, revalued model, these are options given on the date of transition. So any company having intangible assets, they want to get a benefit out of it. Lots of companies are doing. Lots of companies are doing. That is deemed cost, fair value. So whatever fair value will come, the asset will gone up and the credit will be there in intangible transitional reserve. So it's a reserve entry. In future, this particular asset will be amortized to your P&L. But today your net worth will go like boom.
Will you amortize against P&L or that is a transitional reserve?
No, P&L. Transition reserve is fixed. But ministry is yet to come out with any disclosure standards that whether this particular transition reserve is a free reserve or not. So yet it is not clear.
Since it is not realized, it can't be free reserve for distribution of dividends.
So that not yet clear. That's what I am saying. So both options are there, deemed cost or fair value. If you have choose fair value, so you have to fair value on the date of transitions. So fair value will give you an increase or decrease. If you want to take impairment, ulta side, just reverse. there is an intangible asset, but you never took impairment charge, because if you took impairment charge, it will hit in your P&L in Indian GAAP. So you don't never expect your negative results in your Indian GAAP. But today you have a golden opportunity. What opportunity is there? You fair value that particular asset at 0 or 1 rupees. So whatever difference is there, though, that go and sit in the transition reserve. It will directly hit your transition. So that option is there. You can do dim cost or evaluation model. Dim cost, again cost, previous gap carrying value, you just shift it to Ind AS. That is, if my intangible asset block in the previous gap is 1000 rupees, then I will just simply shift that to Ind AS accounts on the date of transition 1000 rupees, or I will do fair value up or fair value less. That fair value up and less will go and sit in your transition reserve.
So why we call it dim cost then? We can call it cost only.
Dim cost means, sir, again, Ind AS, IFRS is a principles driven, and the IFRS standards are applicable retrospectively. Always retrospective application. This 101 standard, which is IFRS 1 comparable, this standard is a once in a lifetime standard. You have to, once you have used it, you cannot use it in future, because it's a transition standard. So in transition standard, it's given exemption from your standards retrospective application. So it's called dim cost. In India, it's called dim cost. Okay. If you look at the IFRS 1 also, it talks about that this is an option. But in that option, fair value is there. Previous gap carrying value is inserted by us in India.
If there is reduction in an asset because of the fair value at the transition, then can we debit it to general ledger?
No. Any debit, any credit comes on the date of transition, it will go and hit your, because it's a transitional balance sheet, there is no P&L, so it will go and hit your transition reserve.
Now what happens after the adjustment if the transition reserve has a debit balance?
So it will netted off with your reserves, other reserves.
It will be netted off with general ledger.
The reserves mean other, it's in India's financial, if you look at the our institutes come with a model financials for Ind AS, Schedule 3, Ind AS compliant Schedule 3. In Schedule 3, if you look at, then how it is coming now, equity, other equity, okay, then non-controlling interest, total. So this is how it looks like. So it will be other equity components.
Other equity will have various components.
Yes.
Share premium account, general ledger, revaluation reserve, capital reserve maybe.
Yes. Transition reserve is one of those.
Transition reserve is one of yes. Now if the transition reserve has a debit balance, that is negative reserve.
It will remain in that. Not it will go in the general
So
reserve.
it will remain as negative reserve. Okay. And then for years to come it will be shown as a negative reserve.
So it's on you whether you want to take it to PL appro, because there is a PL also, no?
PL,
Whatever surplus you have carried, so you want to take it. So that's on you. You want to take it. But on the date of transition, it's a transition reserve.
Subsequently, if you take it, then it will become reclassification.
That standard allows. Any question on Ind AS adoption? 101. So cost model or evaluation model, it's the same. If you apply evaluation model, irrespective of all the block money class, you have to apply the evaluation model. So for class of assets, if you are applying for intangible assets, then you have to evaluate all the assets, and you have to follow the evaluation method. And in evaluation model, whatever there in our Indian GAAP, if you look at the Ind AS literature also, there is no difference. Cost model and evaluation model. And one important thing, ITFG, that is our institute's technical committee for Ind AS implementation, there is only one question on this 38, standard number 38, only one question, that is what will be the classification, I think, if I remember, that is in ITFG number 3 bulletin, that is on 313 I think. That is on classification, how you classify intangible assets. And one more important thing which is not there in slide. Earlier we have a reputable presumption that intangible assets we can depreciate, amortize over 10 years. Okay, so that is not there in Ind AS. So any intangible assets with infinite life, you are not going to amortize it. You are going to test for impairment annually. If it is a finite life, then over the useful life you have to amortize it. And how to do the amortization? The simple, how you are recovering the economic benefits out of that, or it's a restrict useful life, then those methods are there. Cost model, revalute model, both models are there on subsequent measurement, but on initial measurement it's always cost model. But as we are all are transiting to Ind AS, we are going to adopt Ind AS. A lot of companies, phase 1 companies already did, phase 2 companies are going to adopt it. So in 101 for intangibles, there are options. Please choose those options carefully, because those options will be available only in lifetime. Once you choose it, it will be there for you. So on the day 1, day 0, when you are drawing transitional balance sheet, so you have to look into that. So most of the companies, most of our practicing members, those who are going to audit the first Ind AS financial statements in March 17, first Ind AS financial statements, they have to look into the opening balance sheet, that is 1/4/2015, then comparatives 31st March 2016 and 31st March 2017 is the first Ind AS financial statements. At that point of time, you need to look into the accounting policies this company has chosen at the time of first time adoption, that is 101. 101 is the most crucial and important standards, and it will be less important after 3-4 years when all the companies are transacted to Ind AS. Today it is most important standards, but to understand Ind AS 101, you have to read through all the standards, then you read 101. Otherwise, we will never know what is 101. Yes, sir.
In the case of 2017, you told that first April 15 and March 16 has to be recasted as per Ind AS. But in case of half-yearly reporting, whether that has to be followed also? No?
If it's a listed company and it is a phase 1 company,
Right.
for half-yearly reporting,
Right.
first transaction date is 1/4/2015, comparative period will be 30th September 2015, and reporting period is,
Is that required for half-year also?
yes, if it is a mandatory list, phase 1 company,
Is mandatory phase
yes, there is no exception. If you look at, there is in SEBI, if it is a listed one, SEBI comes with a circular, 2 circular. If you look at LODR, LODR is listing obligation and disclosure requirements, which is the replacement for listing agreement. If you look at LODR, I think July 7th or July 8th, the circular number is for regulation 33 for equity listings and 52 for debt listing. So 33 it talks about for June quarter, September quarter, December quarter, it is not mandatory to give the equity reconciliations and comparative informations, and if you are giving also, audit is not mandatory. Okay, however, in September quarter, if you are giving 31st March 2016 financials as a comparative, then you have to give the reconciliation as per the requirement of Ind AS 34. This is what's the requirement.
And date is remain extended till 14 December.
That is 45 days. Earlier 45 plus 30 days, 75 days. Any question on both the standards or any standards? Any question?
So laser litigation can also be a cause of impairment against an asset.
Indicator.
Like say for service toll plazas, a suit is filed, which can, if it results against the company, then it will cease to get the any toll. Can it be, I mean, normally companies say that we are taking legal opinion and we are confident of our position.
So you need to evaluate that particular situation, whether the case is in the favor of the company or against of the company. If it is in the favor, then definitely there is no impairment, but it's an indicator. You can go for impairment.
Normally, sir, companies take a counsel opinion and say we have taken legal opinion, we are very confident of winning the case, and then they lose the case, and then the entire thing has to be impaired in one shot. Maybe the company will not remain a going concern also.
True. What to do? There is a way. Any question? Any other standard you want to? Any peculiar things you want to understand? Then I can spend. I have 10 minutes. Anything.
So these pharma companies, they keep buying and saving of drugs.
Sorry?
Pharmaceutical companies, they keep buying and saving of drugs, even cosmetic companies.
Yes.
So where can it be accounted for at cost and then amortized?
Which one? Brands?
Yes.
When I am purchasing it, if this particular assets, so whatever cost I am purchasing, there is a cost of it.
Then it can be amortized or
If I have already purchased a particular brand and I am going to Ind AS, so I have an option to do fair value, and I can do the fair value of that assets. If I have already paid higher, today I am not able to get that benefit out of it, so I will reduce the fair value and take the hit. If I am getting higher, then I will increase my net worth. Any questions? Thank you all. Okay, and my mail ID is mnayak@deloitte.com. Okay, so mnayak@deloitte.com. Any questions? Anything on Ind AS? You can reach me out. I definitely try to get the answer for you. Okay, so
Tell your email ID once again.
mnayak mnayak@deloitte.com.
Thank you.
M dot.
it's at one.
It is continuous and
No, nothing. mnayak.
Can you give the phone number, please?